investors are placing hundreds of open buy orders in different price zones. It seems that they're waiting for Bitcoin to drop even further. What are the most important liquidity zones? What fundamental factors are influencing the price? What does the American GDP reveal? What about consumer confidence? What position do central banks hold? Are we on the verge of a recession? Before answering all of these questions, let's carry out a technical analysis on the price of Bitcoin. In the monthly time frame, we can see the closing of the June candlestick. It is a nearly full-bodied candlestick that managed to close below the 50-period moving average. This is the first time that this has ever occurred in Bitcoin's weekly time frame. In addition, we can see how it has lost the previous cycle's high. The $19,700 zone was the previous resistance and the new support, a relevant support zone that lost and touched the $17,600 zone, although it did manage to close above the $19,700 zone. At this moment, if the support area were to be lost, the price could head towards the $14,000 zone. That price level has served as a resistance in December and January 2018, June 2019 and October 2020. And another important thing to note is that the RSI has lost the 44-point zone, which hadn't ever occurred in Bitcoin's history. If we take a look at the weekly time frame, we can see that large candlestick between June 13th and 19th. A candlestick that managed to lose the important relevant support zone and went on to test the approximately $17,600 zone, which formed at least one spike. This reveals significant interest on behalf of bulls, where several limit orders were placed. The week starting June 20th, a doji candlestick formed, which was maintained within that support and resistance range. This week, starting June 27th, we can see how the bearish movement is continuing and a bearish candlestick is forming. This will be revealed towards the close of this week. With the displayed moving averages, we can see that we haven't been able to recover that $21,000 resistance and we're remaining below the 200-period moving average, which is a clear sign of a downtrend. And here, similar to the monthly time frame, we can see that Bitcoin has never been in an important oversold zone in the RSI. Last week, the price had already lost these lows and now places itself at around 25 points, heading towards the oversold zone. And now we'll have to pay close attention, as in the event of seeing a full-bodied weekly candlestick, it could indicate a continuation movement. In Bitcoin's daily time frame, we can see that following the massive price drop approaching the $17,600 support zone, a significant rebound took place until June 25th, reaching $21,300, but wasn't able to surpass the resistance that served as a pivot zone. This rebound was accompanied by decreasing volume, which wasn't exactly a good sign. In our previous analysis, we had already mentioned the possibility of testing the support at $19,300, and what we can see are 6 consecutive daily bearish candlesticks. The candlestick on June 30th carried out a downward movement which managed to make its way towards the $18,600 zone, but formed a spike until closing above $19,700 due to the limit orders absorption, which we'll be covering later on. Looking at the candlestick on July 1st, a fleeting movement was carried out until reaching the 20-period moving average, which served as a pivot zone. If it now loses the $18,600 zone, the price could head towards the inferior part of the $17,600 zone. If that zone is also lost, the next relevant zone would be between $15,000 and $16,000. To see a movement reversal, we'd have to see volume input and candlesticks closing above the superior part of the previous candlesticks. This could push the price back to the important resistance zone at $21,400. On the flip side, if the candlesticks close below $17,500, we'd probably go on to test the $15,000 to $16,000 zone. And if said zone is surpassed, the next relevant support would be placed between $12,000 and $14,000. Be sure to watch the entire video to discover the importance of said areas. And if we move on to the SP 500 chart, we can see that incredibly relevant zone of 3,600 to 3,700 points, where a reversal pattern with a classic doji candlestick formed and progressed into a full-bodied daily candlestick and a continuation movement towards the upside in order to continue with the movement from June 17th to 27th. And that's where the movement was paused, in an important resistance that converged with the 20-period moving average. The shooting star candlestick on June 27th created an evident evening star pattern, a green full-bodied candlestick, grave doji or shooting star candlestick, and a red candlestick that exceeds half the body of the previous engulfing candlestick. When the pattern is fulfilled, a downward continuation movement is carried out, and when losing that zone, the SP 500 could go on to test the 3,700 points. Since March 29th, when the SP started to fall, we can see how a convergence occurred between the price action of the SP and the RSI, meaning they're aligned. Therefore, if we were to see changes in the structure, we would first have to see a divergence that is capable of changing the bearish convergence. For now, the index will probably head towards the support between 3,700 and 3,600 points. Otherwise, if a pullback occurred, it would have to surpass the 3,840 zone to be able to test the downward trend line that coincides with the 50-period moving average. If we take a look at the dollar chart, we can see that since February 2022, a minor uptrend has been forming. On May 12th, we can see a fake out in an attempt to surpass the important resistance zone at 103 points approximately, and then went on to test the 50-period moving average. Following the rebound, we once again saw a crossover on June 10th. Following the pullback, it once again returned to the resistance zone, which at the moment looks to consolidate in that zone. If this were to occur, it could go on to test the 108-point zone. On the contrary, it could lead towards the minor trend line that converges with the previous resistance or the new support and the 50-period moving average. We can also see two consecutive bearish divergences in the RSI, but have yet not come into effect, as this increase in the dollar could be a result of the massive sale of actions and bonds in markets. Some sales caused by the economy's instability, which we're now going to analyze. Negative forecasts have become a reality in the United States. The country's GDP has fallen by 1.6% in the first quarter. The United States attributes the drop to the COVID rebound and the Omicron variant, and ensures that 9 out of the 22 industrial groups in the country have influenced this GDP drop. Let's not forget that if in the second quarter a new contraction of the GDP has been registered, we would technically be facing a recession. But the bad news doesn't stop there, because the United States rate curve has inverted. As mentioned in this video, the yield curve has always been an early indicator of a recession. Following the US's negative GDP data announcement, Jerome Powell, chairman of the Federal Reserve, warned that the economic slowdown could be the result of an aggressive monetary policy, a necessary monetary policy that is intended to curb inflation. In fact, Powell defends the rate hike being carried out by the Fed, a sharp rise that has not occurred since 1994, and this could impact the growth rate.
Our aim is to have growth moderate. It's sort of a necessary adjustment that needs to happen so that, again, supply can catch up. It could be.
Powell's pessimistic point of view has been accompanied by the release of more negative data. Consumer confidence in the United States continues to plummet, reaching the lowest level seen since February 2021. This data is taken into account when making macroeconomic forecasts, since it predicts consumer spending, and that spending of consumers represents a very important part of economic activity. The PCE price index, also known as the PCE deflator, is a US-wide indicator of the average price increase for all domestic personal consumption. The personal consumption expenditures price index for May rose by 6.3% since the previous year, reflecting increases in both goods and services. Energy prices increased by 35.8%, while food prices rose by 11%. Excluding food and energy, the May PCE price index rose by 4.7% from a year earlier. And now, if we move on to the Eurozone, the President of the European Central Bank, Christine Lagarde, assures that the institution is willing to go as far as needed to contain inflation.
And we will go as far as necessary to ensure that inflation stabilizes at our 2% target.
And general inflation data, according to forecasts, stands at 8.4% in the month of June. Although if data is eventually worse than expected, markets could react negatively. And in the Eurozone, unemployment has been a little better than expected and stands at 6.6%, slightly less than the 6.8% that was expected. In Spain, inflation data for the month of June was revealed, which sits at an alarming 10.2%. This figure has not been seen since 1985. But aside from this, the underlying inflation data is 5.5%. So we're not just talking about a temporary CPI issue, but rather a structural situation. And now let's move on to an on-chain analysis which looks at the data offered by the blockchain. On the URPD chart, we can see that around 1.4 million Bitcoin were exchanged within the recent low of $17,600 to $21,600. This means that after the recent supply redistribution and capitulation event, a retest of those lows would cause an equivalent amount of Bitcoins to be at a loss, as occurred during previous bear market bottoms. Previous bear market bottoms have coincided with a percentage of Bitcoins in profit of between 40 and 45%. During the sell-off at $17,600, the market experienced a supply profit of just under 50%, triggering a significant case of capitulation and redistribution. The net result of this redistribution is that a large volume of Bitcoin has now been exchanged below $20,000. If we consider 40 to 45% of bid in profits as a potential bear market bottom threshold, how far must the price now fall to reduce an additional 5 to 10% of Bitcoins in losses? We'll be discussing this towards the end of the video, so be sure to stay until the end. In this chart, we can see the balance of Bitcoins in exchanges continues to decrease while many holders continue to transfer their Bitcoins to cold wallets. This is displayed in the following chart. An exchange net position, or net inflow, is an indicator that measures the amount of Bitcoins going in and out of wallets of all exchanges. When the value of the indicator turns negative, it implies that a net amount of tokens are leaving exchanges as outflows dominate inflows. In the chart, we can see the largest Bitcoin outflows from exchanges in the entire history of Bitcoin, where, for example, we can see that on June 26th, 151,000 Bitcoins were withdrawn, the largest amount ever seen, surpassing that of April 14th of 2020, which were about 141,000. Here we can see the relevance of the area between $18,000 and $19,000, in which we can see most buying and selling interest. In the event of losing it, we could face a new distribution, carrying out a price construction once again and therefore lead to the area of $16,000 to $17,000, where the next relevant zone is located. If this were to be exceeded, it would head towards a zone between $13,000 and $14,000. The relevance of this zone is displayed in the following indicator. Realized price by address displays the average price at which all current unspent Bitcoins were bought based on the size of the wallets. Here we can see the realized price by addresses, which are below the majority, except for the portfolios holding between 10 and 100 Bitcoins, where said price has historically marked the minimum price of the Bitcoin bearish market. Statistically speaking, it is now located in that important area of 12,900. Perhaps this is the price that we discussed in the URPD? And in this chart, we can see the relevance of the large Bitcoin purchases made. Specifically, it is the Bitcoin USDT pair on the Binance spot market. We'll have to wait and see if the price exceeds the orders established in these areas drawn in blue. If not, the next major cluster is at around $18,500. Below that area, we can see a lot of limit orders sitting between $17,000 and $18,000. In this heat map, we can see that there are no large sales areas at the top. What we do see is an agglomeration of liquidity zones due to buy orders between $15,000 and $18,000. And on this chart, we can see that on June 25th, the futures market experienced a change in direction and sales prevailed over purchases as reflected by the delta volume, while also being accumulated as seen in blue. In addition, we can also see how spot markets CVD continues its movement since June 27th more subtly, and now we're found in a lateral phase. In short, many investors are waiting for price falls in order to obtain Bitcoin positions, some falls that could occur if the negative macroeconomic data continues to offer a far from encouraging outlook in the short and medium term. The tighter monetary policy of the Fed and the European Central Bank could lead us to a recession on both sides of the Atlantic.